Hello and welcome, everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It's Tuesday, March 22nd, 2022, and I'm pre-recording this Trading Places Live for just a little bit later this morning. Currently, we have futures up decently. Dow Jones futures up 161 points. S&P 500 futures up about 12.5. NASDAQ futures up about 25 points. So it looks like we're going to get off to a pretty decent start after a relatively flat Monday. Crude oil prices down just barely, maybe about a dime or so, currently at $112 a barrel. It has been on the rise again, though, lately after pulling back rather substantially last week. The 10-year Treasury yield up another 2 basis points, so we're up to 2.34% now. This is the highest level we've seen since May of 2019. We'll see whether or not that continues to the upside. I think in the short term, it probably will. Longer term, I'm not so sure. But right now, the market is definitely more in inflation mode. And if the market feels like inflation is a problem or could be a problem, that normally is when you see those longer term yields moving higher, because investors expect more return when inflation is on the rise. Let's walk you through today's agenda. I'm going to start off, as I always do, with the daily market recap. We'll go through talking technically. Going to look at the S&P 500 over different time frames there. Then we'll get into breakouts, and I'll show you at StockCharts, if you haven't seen it, how you can just use their predefined scans to go through and find breakouts that might be interesting for you. Then we'll get into the earnings spotlight. Not a whole lot going on there. Got a couple of companies. One big one reported last night. And then we'll take a look at some that are reporting today. And then we'll wrap it up with the 3 you must see. And there I'm going to take a look at the 3 best performers on the Dow on Monday. So maybe a little different variety of versus some of the stocks we've been showing. Of course, I tend to focus on a lot of the growth stocks, and that's not what we're going to look at in the 3 you must see. All right, let's start off with, before we get into the daily market recap, I just want to show you over at earningsbeats.com. If you want to join me, you can come over here, scroll down, and go to our Earnings Beats Digest sign up page. You simply type in your name, email address, hit that subscribe button. We'll make sure we get our 3 times a week newsletter out to you. It comes out every Monday, Wednesday, and Friday morning, usually about an hour before the market opens. So normally we try to get it out around 8:30 or so Eastern time. We focus on anywhere from relative strength, earnings, upcoming earnings, gaps. They could be earnings related or not, but usually I focus a lot of my trading on earnings related gaps. So I like that. Candlesticks, those sorts of things. Also, we're going to have a free event tomorrow afternoon after the market closes. Q1 market update. Very, very timely, given everything that's transpired so far in 2022, the huge drop, the rebounds, now what's going on with inflation. The Fed now has announced 9 rate hikes probably over the course of the next year or so. So what do we do with all this? Where are we going from here? That's what we're going to be looking at in this event. And it is a free event, but you do need to be on our EB Digest, because this is the group we're going to be reaching out to in addition to our paid members. We're going to be reaching out to our Digest community. So if you haven't already signed up, make sure you do. Name, email address is all it takes. And again, just go over to earningsbeats.com and then scroll down and you'll see that sign up form. All right, daily market recap. So what happened on Monday? Well, not a lot. And I think it made some sense to me that not a lot transpired, because we were up against some key areas, not only the 50-day moving average, as you can see here on the Dow and S&P and NASDAQ and so forth, but also on the weekly charts, the 20-week EMA, which when you're in a longer term downtrend, and we've been downtrending now throughout this year, that's one of my favorite moving averages to watch. Even when we go through a period of strength like we've seen over the past week or so, can we get through a sustainable move through that 20-week EMA? And if we can, what do our sustainability ratios look like? And so those are the keys right now, I would say, this week. Can we continue the strength we've seen? Because we are right up against these 20-week EMAs. And I'll show you when I go through the S&P 500 in a bit and look at the different time frames. I'll show you that weekly chart, what I'm talking about. But anyway, the Dow Jones Industrial Average yesterday down 201 points. S&P, though, only down 2. NASDAQ down 55. So on a relative basis of those three, the Dow Jones was the worst performer. Mid caps down 9, and then small caps actually down a little bit more on a percentage basis than the Dow, down 9 points, but about 2/3 of 1%. Look at the AD lines, though, here across our major indices, all of them moving back up to recent highs, and in some cases to all-time highs. So the Dow, S&P, and NASDAQ, look at the price action continuing down, but look at that AD line. So even though prices have been going down, when we have seen the volume come in, for the most part, we have seen rallies. And that's a good sign. It tells me that there are still plenty of buyers out there for those that want to sell out because of all the bad news. And it also plays into my theory that we are still in a long-term secular bull market. We could go down one more time. We might not. We may consolidate over the summer. I don't believe the market's just going to go straight up. I think there's a lot that we've got to work through. I still think there's some work to be done with sentiment. So I don't think we just go straight back up. Part of this we saw last week, I think, had to do with Max Payne and a lot of the options expiring, a lot of in-the-money puts. So this actually saved market makers or made market makers a lot of money, depending on how you look at it. But now that we've got that in our rearview mirror, I think moving to the upside from here is going to be much more difficult. I would not expect these kinds of big moves, 400-point days on the NASDAQ. Not saying it can't happen. I just don't think we're going to continue to see that kind of movement to the upside. At least I'll be surprised if we do. Instead, I think we could just meander here for a little bit. Maybe we go up a little bit further. Like I said, that 20-week EMA is upon us, so that's going to be very difficult to negotiate probably. But we'll kind of just take it day by day. Let's see what the market serves up here. From a sector perspective, energy back on top last couple of days, last few days, you can see now starting to bounce off that 20-day moving average, getting back close to the recent highs. As long as crude oil price remains where it is or continues pushing higher, I don't see why energy doesn't go higher. So I would be looking for another breakout here on energy. Materials, we've still got certain areas of materials, commodity prices that are rising. I think that's obviously helping to lift some of the material stocks. I'm not sure, I don't expect the kind of rally in materials that we have seen in energy, but I wouldn't be surprised if materials do make it back up to that January high. Wouldn't be that far, another 3% or so. But I'm just wondering if the money going into energy and materials is going to be coming out of discretionary and technology and so forth, because these groups are now testing key moving averages. You can see discretionary right there. This group's remained under pressure, not only on an absolute basis, but more obviously on a relative basis. Things have been very weak. But notice the AD on the consumer discretionary here last week, another straight move up and a break to a 6-month high. So we've got some pretty good action in terms of the accumulation indicators at StockCharts. So I think that's a good sign. Communication services was your worst performer on Monday, and this has been a group that's been under pressure now for about 5 months. Not really a whole lot changing there. You can see we did get through the 20-day, but unable to get to the 50-day. Even though all these other indices and sectors and everything we're talking about are at or above the 50-day, you can see communication services is the one that has not been able to get back up there. It's been our worst performing sector. And with stocks underperforming right now, like Facebook, and even maybe to a lesser extent, Google, it's going to be difficult for communication services to move higher when many of these big internet names are still struggling. Discretionary, real estate, you can see real estate here moving back up. I think real estate's got a little overhead resistance as it gets close to 48. It is defensive though, so if the market turns back down, I would expect some relative strength showing here in real estate. Moving on to the 10-year Treasury yield. Doesn't show it here, but right now, let me give you an update. Yeah, 10-year Treasury yield currently, it's about 2.34%. So still up a couple of basis points here. We finished yesterday 2.315. Right now I'm showing 2.337. So it does look like we are going to continue this push to the upside. What has been interesting here to me on this chart is notice that as we're going straight up in the yield, it looks like financials, first of all, never even got close to the relative strength of financials back in February at this top. Normally what we see is when you're looking at the chart of the 10-year treasury yield, down, back up, down, back up, down, up, down, up, you tend to see the relative strength of financials going in the same direction as the yield. And having audited banks for many years, I do have experience with seeing the different changes in rates and how it impacts financials, especially banks, life insurance companies, things like that. And this is what you would expect. Now, the fact that it isn't going up here while rates are going up tells me that a lot of the selling taking place in the bond market right now has more to do with inflation than it does anything else. So it seems like maybe there hadn't been a whole lot of fear about inflation in the bond market until the Fed came out last week and said, we see problems with inflation. Might be a little bit late to the game. We're going to find out. But anyway, this is what it looks like to me, because with this move to the upside, we're not seeing that breakout on a relative basis in financials. And we've had a huge move up here in the yield. We should be seeing a lot of strength here, and we should be breaking out above that February high, and we're not. So that's why this chart anyway is telling me that the move up in yields and the selling that's taking place in bonds right now has more to do with inflation than it does with a strengthening economy ahead. That's normally why we would see rates moving up. And that's normally why financials would do well, because in a strengthening economy, they're going to see their net interest margins widen. In a weakening economy, they're going to see their net interest margins contract. And I believe with the Fed's statement and with their, desire to raise rates multiple times, many times, potentially over the next year, if they do that, I can't see how the economy remains in positive territory. I think we'll have a recession. So that is part of what's going on here. So this is a pretty complicated time. That doesn't mean the market's going to have this massive sell-off. It doesn't mean that at all. We've had plenty of recessions in the past. I do think the Fed, if they're going to pick their poison, they're better off getting inflation under control. That's much better for the long-term picture. Now, whether or not I agree with how many rate hikes doesn't matter. I think what is happening is that the stock market is now at least feeling like the Fed is got inflation or will get inflation under control. And that's important to stocks. So that's what I'm seeing here. Okay, let's move on to talking technically. So let's go through the S&P 500 and through these different time frames. So I thought I'd start off with a 60-minute chart. This is a 4-month 60-minute chart. This is as high as the 60-minute PPO has been over the last 4 months. The last time we saw anything close to this was the rally off of that January 24th low. Remember when we took that first plunge? Saw the VIX get up to about 38, 39. And I even sent out an email to members saying, hey, this is unusual to see the VIX this high and that normally we see a bounce. Well, here was your bounce. We established that bottom, went up, and by the early part of February, you can see we had the PPO topping, the hourly PPO topping up near 1.0. And then we never went any higher than that. Well, here we are back at 1.0 again. Can we break out? What I would be looking for here, just to annotate very quickly, is I think we have major double top right here. When you look at this as a downtrend, you go down to this low. Here's your reaction high. Here's this low. We never went below this low. So as far as I'm concerned, right now, we are in an ABC. It's an extended one, but we are in an ABC. Moving back up and getting through 4,600 would be a big deal from a price perspective. And we can talk about moving averages. We can talk about sustainability ratios. Bottom line, I mean, technical analysis starts with price action. So if you're looking at this, I'm seeing a move down here to set a low, a reaction high to set a top, double top, which is even more significant, I think. And then we went back down to a new low. Some might say, well, why isn't that one? Well, we never went on this move. We never went back down and set a new low. That's why this high right here was not important. Moved up, we moved up here, moved down, Oh, we're breaking out above that high. That should be good, right? No, because we never established another low first. So we've got this low, reaction high, this low, and right now we're kind of in no man's land. I mean, I think we're in between this range of the low that we saw at the end of February and the double top from a price perspective. So we still got room to get up to 4,600 without breaking this downtrend. But getting up to 4,600 would look good on a couple of other fronts. And that's, first we'll take a look here next at the daily chart. So the S&P 500 on the daily chart had the big move up. September was the pullback, rallied, pulled back, and rallied one final time. And in December, this is where a lot of the warning signs came together at the same time. When you're just looking on the surface at the S&P 500, you say, wow, breakout, end of December, going into January, which tends to be a really good month. Here we go. We're breaking out. We're going to go higher. I was actually warning back at the end of December because, well, for a number of different reasons, but one big one was that defensive groups led this last rally. And if you've studied the market history, you know that that's how many market tops form. Defensive stocks leading the rally. And the reason is very simple. Wall Street, which obviously has a lot to do with which way the stock market's going. There's a lot of money involved and a lot of smart money on Wall Street. Wall Street's moving out of aggressive groups and into defensive groups as the market is setting that final high. If Wall Street believes we're going higher, you're not going to see them exiting technology and consumer discretionary stocks in favor of healthcare and utilities. It's just not going to happen. Those healthcare and utilities is not what leads the market in rallies. So when you see that final rally and it's being led over the entire month by defensive groups, and for the month of December, the 4 defensive groups were in spots 1, 2, 3, and 4 on the monthly sector leaderboard. All 4 defensive groups led that rally in December. And so that was a big problem. And then we had the big swoosh down, set the neckline, moved back up, put in the right shoulder, and then we broke down. But the breakdown was kind of, sketchy because we made the breakdown on volume that was not even heavy volume. Normally, you would think we've been in this bull market for a long time. That was probably the biggest breakdown. I mean, obviously we had the pandemic, but let's ignore the pandemic. I would say it was the biggest breakdown, even more so than 2018, the trade war. You could argue that because on a percentage basis, the S&P 500 lost more ground. But that was a pretty big breakdown going back throughout the last several years of this secular bull market. And yet, where was the volume? And then we came back up and rallied, tested the 20-day moving average, went back down, put in a double bottom, and now we're rallying again. On this particular chart, I'm going to say, that it just looks to me like maybe the bottom is in. I was thinking, when we were in this bottom, we were probably going to bounce here. And I felt like right here, as we started to roll over, we were probably 75, 80% chance we were going to break down, at some point and go lower. And I would say at this point, especially yesterday, it looked like we were breaking down intraday, and then the market rallied back again. It's been showing a lot of this resilience. One thing to keep in mind, as long as it keeps putting in a higher daily low, then it's going to continue to be in this uptrend. Now, it did print a doji yesterday. So after 4 straight days of hollow candles, didn't see that yesterday. Maybe that's a sign of a little bit of weakness creeping into the market. We'll see. But you got to at least start showing lower daily lows and lower daily highs to begin a downtrend. We haven't started that yet. So let's respect what we have here. We also had lower closes and higher PPO reading. So we had a positive divergence. A lot of times we look for 50-period test and centerline tests to kind of reset the PPO. So that's now taken place, or is certainly well in the process taking place. 50 days been tested. So when I look at the daily chart, we can still see this double top over here at 4,600. But when you start breaking above moving averages, it starts giving you the flavor of a sideways consolidating market rather than a downtrending. And so this move here, and I know last week was options related, so I'm not getting overly excited about that from a bullish perspective. Once that's ended or is in the process of ending now, we're starting to see the market maybe struggle just a little bit. We'll see what happens the rest of this week. If we roll back over, then I think, we lose the rising 20-day moving average, then I think we've got a pretty good chance that we're going to go back lower again. But you got to be at least somewhat impressed that we've been able to get back up through the moving averages above this March reaction high here. So at least some things are turning up for the bulls. Then we've got the weekly chart, and this is where I still believe there's a chance we go lower. You can see the weekly PPOs now turn negative. And even with the huge rally last week, we barely budged on the PPO back to the upside. We're still sitting below the zero line. And notice yesterday we closed at 44.61.18. The 20-week moving average, 44.61.53. We are sitting almost squarely on the 20-week moving average. And the failure that we saw in January, remember when we bounced off of that first move down? I showed you back here on this 60-minute chart right here. There was that January move, and here's your bounce. So on the hourly chart, looks pretty good getting through moving averages. The weekly chart tends to drown that noise out. And you can see, yeah, it was a bounce, but we couldn't even get through the 20-week moving average, and then we rolled over. So the weekly chart is our big picture chart. This is the chart that tells us that we're not out of the woods. Even though the daily and the hourly make us feel really good, things have kind of changed. The weekly tells us otherwise. And if you go back to 2018, I want you to look at these moves up in 2018. The first move down, there's your rally. First move down, there's your rally. Failed it at the 20-week. See how we failed at the 20-week? We ended up coming back up and testing that price high, but we couldn't get a weekly close above the 20. So I would say it's this combination, price resistance and the 20-week. So intra-week, might we get up to that 4,600 or close to 4,600 or maybe even end of week? But can we negotiate both price resistance and the 20-week moving average? We haven't done it yet. So just keep this chart in mind from a longer term perspective. We still potentially have some issues here. All right, moving on. Let's take a look. I wanted to show you breakouts and how you can do this just using your dashboard, going down to your scans. If you don't see your scans on your dashboard, then you need to check this gear shift thing right here, the gears, and make sure that scans and alerts are checked off. If they're not checked off and you go down, you're like, I don't see them. I don't know what Tom's talking about. Well, go back to the gears, check it off, and hit save preferences, and then you'll see your scans. Under the more, go to predefined scans. Look at this, 52-week highs. There were 298 of them broken down by these various indexes. So we've got our exchanges. We've got New York Stock Exchange here, 126. So if we wanted to see some of the stocks, we just click on it. Now, if you could go through and look one at a time, but if you wanted to manipulate, what you could do is just click save on chart list. And we'll just type in a new chart list. Let's let's NYSE 52-week highs. All right, so save the chart list. And now we've got it in a chart list in summary form. And that was yesterday. So when the market opens today, we can quickly see which stocks are following through. The other thing you can do is you can sort this by scooter. Now you can see also that there are going to be some ETFs on here. So if you wanted, you could go ahead and edit and delete some of the ETFs out if you'd like. Here's some more ETFs down here. You can sort it by sector. What sectors are leading? What different areas are providing these 52-week highs? Well, number of utilities. When 52-week highs, when you've got 11 utilities and 3 technology, that's kind of telling you something about the stocks that are making 52-week highs. 2 staples, 6 real estate, bunch of materials, several industrials, lots of healthcare. I've got a pretty good amount of financials. Energy, still a lot of energy. 2 discretionary. 2 discretionary. And go up here to technology, 3 technology. First of all, any technology stocks that are breaking out in this kind of market when technology is out of favor, probably worth considering or at least looking at. They're probably, doing some things right. I know computer hardware has continued to do pretty well. Pure Storage has been one of the leaders. Well, there was your 52-week high just breaking out. Now, maybe it holds. Maybe we get a pull back to the 20-day, but this is a stock that's been doing really well. And if we look at that relative strength chart, go down here and you can see Pure Storage relative to computer hardware is breaking out. Computer hardware has actually held up pretty well versus the S&P 500. Some of that's due to Apple, but also some of it's due to other companies within the group like Pure Storage. So computer hardware continues to perform really well. All right, let's move on. So that's just, a different way to kind of zero in on whatever it is you're looking for. There were a lot of energy stocks. So if you're an energy trader, you could go in here and just look at your energy. Go down to the energy stocks. There they are. And they're in scooter number order. If you sort by scooter first and then go to sectors, it keeps your order of scooters within the sector. So you can see some of the high flying energy stocks right here on your list. If you want to get maybe some of an energy that have broken out or recently broken out, look maybe to the lower scooter scores, because maybe these are stocks that haven't done quite as well recently and are just now beginning to make breakouts. So that might be a different strategy as well. Anyhow, earnings, wanted to just talk about earnings for a second. Not really a whole lot in the way of earnings. I did want to mention Nike. And actually, let's see what Nike's doing pre-market. It was up really well yesterday after the market closed, and it's still up 5%. So 137, up $7. It's going to still be below the 50-day, but at least moving in the right direction. I think this is probably nothing more than a reaction off the bottom. So I think we're going to struggle to get through 140. That was a double or triple bottom breakdown. If we can get back through 140, then we're taking out the 50-day, we're taking out price resistance. That would be much more meaningful from a technical perspective. So yeah, it's nice to be up $7, but Nike still has some work to do overhead. Also this morning, CCL, Carnival Corp, due out with its earnings. And right now it's up. I haven't seen earnings, but currently it's up about 0.5%. Been going sideways, really needs to hold on to this 16 area. Back to the upside, you got 23, pretty big resistance. We're in the middle of that range right now, not really telling us a whole lot. Later today, we'll have Adobe. That's a big software company. That's going to be a report that you're going to want to keep an eye on. That could have quite an impact on the software group. So watch for Adobe's earnings later today. 3 you must see. Let's wrap this thing up. Going to go through here pretty quickly. First one, Chevron. I mean, this stock has been heavily accumulated. Look at that AD line. Stock is, it's a hollow candle almost every single day. Great volume. With energy prices going higher, CVX is going to continue to be a great performer. Rising 20-day looks good for entry. Next up is the Dow. Dow Holdings just recently broke out above these highs, so it's starting to show some strength. Needs to get through about $63.50 to $64. So we got a little bit more room here to the upside, but getting through 64 is going to be the chore. If we do, then I think 68, 69 comes into play. Last one, Caterpillar. These were the 3 best performers on the Dow yesterday, by the way. Caterpillar has overhead resistance at 230, so it's starting to look better. I like the AD line setting a new high for the last several months, but we got to get through 230 to the downside. Watch that rising 20-day EMA. That's it for me today. Listen, everybody have a great day. I'll be back Wednesday over at earningsbeats.com for your next Trading Places Live. Have a great day, everybody. Happy trading.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're going to bring you daily content from an incredible collection of technical analysts and financial experts.